Hello friends, welcome to another edition of the Lucky Talks. It's always a pleasure to connect with all of you, and I think the journey over the last 18 months or so has been quite remarkable, wherein we've seen the markets uh, actually go past their all-time highs and reach where they have reached, courtesy the global central banks giving out liquidity and lower interest rates globally. So what we are seeing in India in terms of the equity markets is something which is happening globally as well. And it is not just the equity markets, but the commodity markets. If you look at zinc, aluminium, copper, all of them are at almost their lifetime highs. And also, if you look at the property markets globally, and even in India, it is shaping up. So the liquidity which has been brought out by the global central banks over the last 15 to 18 months after the pandemic struck has helped the risk assets, or has helped the assets, financial as well as physical assets, to get repriced. In other words, the prices of goods and commodities have gone up because of the easy liquidity and the lower interest rates which have been made available. What it has also done is that it has ensured that the economic recovery, which we were all expecting to happen in India, has happened faster. And we can see that in terms of the corporate numbers which are coming out. The corporate numbers for the last 2-3 quarters have showcased growth, and we believe that in the next 2 to 3 years has happened given where India's economic cycle is. We can see that in terms of corporate numbers will be supported. Having said that, from an investor perspective, we have always been proponents of asset allocation. And as far as investors are concerned, we again reiterate that you should have an asset allocation plan based on which your allocations to equity, debt, gold, etc. are determined. And once you have your asset allocation goals planned, then you can decide which funds or which set of schemes suits you. An advisor obviously will be very helpful, because for us to keep a track of all the events which are happening as individual investors is extremely difficult. You will find probably it overwhelming that what all is happening and how do I probably capture everything as part of my portfolio. That's where a distributor or an advisor can be very helpful in probably helping you curate the right mix of funds for your own portfolio. The discussion today, of course, is mainly around the ICICI Prudential Consumption ETF. We are very happy to launch the Consumption ETF. It's opened on 18th of October, and the NFO period will go until 25th of October. That is next Monday. And here, basically, it's a very simple concept wherein you are basically looking at those companies which benefit from Indians' spending or India's consumption story. So you're basically trying to aim to find wealth where India spends as a country. And if you look at it, why in an ETF form? We've seen increased Demat account holders in India. The number of Demat accounts today is more than 7 crores. It was about 5.5 crore Demat accounts in March 2021. And in September 2021, it has crossed 7 crores. So the speed with which financial inclusion is happening with bank accounts, with Demat accounts, is pretty strong. And that means that the growth of ETFs in India will also be strong, is what we perceive. With the growth of ETFs in India, investors will demand different sets of products. There could be market cap based, that could be sector thematic based, and that could be smart beta based. We are hopeful that we are able to provide to you all the potential products across the ETF basket which you may require for your asset allocation requirements. As part of the string of funds which we have brought out on the ETF platform, we are happy to bring the consumption ETF as well. Very recently, about 2 months back, we had launched the FMCG ETF for our investors who wanted to participate in the FMCG stories of India. The consumer stories is a bit wider. The consumption ETF has different sectors, and I'll touch upon that as we move along. But our endeavor is that as an investor, whatever is your requirement in terms of funds, we should be able to have it on our platform for you to participate in the equity markets. India's equities, if we see, in 2008, we were a $1 trillion economy. Today, we are a $3 trillion economy. It is expected that in the next few years, at some point of time, we will become a $5 trillion economy. And if we look at the move between 3 trillion to 5 trillion, that will be reflected upon the listed space as well. With the pandemic, the small and medium enterprises in the unlisted space have gone through their own troubles, and hence the listed space in terms of market share gain and in terms of their growth have probably got strengthened. With interest rates being low and India's economic growth recovery being stronger, we expect the equity markets to be able to deliver good returns over the next few years. There will be volatility, but from an investor standpoint, what is most important is the idiom of buying low, selling high. And that's where the asset allocation schemes are a very important part of your overall bouquet. So once the core of your overall portfolio is in the asset allocation schemes, investors can choose their themes basis their own liking, understanding, and at different points of time what suits their investment needs. As part of that, like I said, we are happy to bring the consumption ETF. Why an ETF? What role does an ETF play? Let's go to the basics. As I said, the demat account holders have increased. In an ETF, you need a demat and a trading account. You buy an ETF much like how you buy a simple share or equity share on the stock market, or you can sell it. You get the benefit of real-time buying and selling. Also, the best part about ETFs is that the entire portfolio of stocks, which an ETF is basically mimicking. So an ETF is nothing but a fund which is having the entire portfolio of stocks in the proportion of its weight in the benchmark index. And you will be able to buy that entire portfolio of stocks with basically nominal 50, 100, 150 rupees of 1 unit price. So you can buy it in single units which are traded on the exchange. And that's the beauty about ETFs. They are very transparent, they are low cost, and you will be able to see the methodologies of each of the ETFs that are there and know exactly what you are getting into. So that's the advantage. These ETFs also get rebalanced every 6 months. That is also something which helps investors to be able to participate in the newer companies. If there are newer companies which become large and fit the methodology, they will come in and something will go out. So it's a self-balancing mechanism in that sense, wherein the rebalance ensures that if there is a company which needs to be a part of the index based on the methodology, that comes in. So the advantage of sector or thematic ETFs in an investor's portfolio, consumption, if for example, if you look at India for the last 10, 15 years, we have grown as a consumption in consumption in a significant way. In fact, consumption as part of the GDP has grown while manufacturing has come down. And it is no surprise because as our population keeps growing, it is estimated that by year 2030, we will have about 50 crore Indians within the middle class bracket. 50 crore is probably more than the entire population of North America, which essentially explains how just a part of the middle class of the middle class population of India, the way they are going to consume, will help the entire Indian consumer story across all the sectors which are forming part of the consumption. And that's where ETFs as a pooled vehicle in terms of having the themes is something which will fit into your overall portfolio very well, because this is exactly in terms of your investments, you will get to know where your money is going in terms of the underlying stocks, basis the methodology and basis the monthly disclosures that are there. In fact, in the case of ETFs, you can actually look at the portfolio on a day-to-day basis with the PDFs that is available on our websites. And that gives you a sense as to what are the stocks that are there as part of the ETF as of date. If you look at India, and let me come back to the ICICI Prudential Consumption ETF, we all know that we have a population size which is young. In fact, while China is aging and the population of China, because it is aging, the working population is reducing. In India, we are a young country, working population is increasing. That gives a very big fillip to consumption. Look at it this way, that in 1970s, it was the time of basically Japan to get the advantage of demographic dividend. Then sometime in 1990s, it was China, and now it is probably India's turn in terms of getting the advantage of demographic dividend. In other words, a younger population who has a higher propensity to spend as well, and they are able to participate in the global growth. Also, India being a big outsourcer, the employment opportunities within the outsourcing have also improved. And that also will ensure that this worry which we have of Indians not getting enough jobs will probably come down. With manufacturing revival happening because of the PLI schemes of the government of India, that is also very heartening to see, because that will also bring employment. The construction sector, the roads sector is also improving. So the worry which we had about unemployment is probably now much lesser in India, which in turn means the consumption story can get much stronger, with more and more foreign investments also happening in India and more capex happening in infrastructure in India. So from a consumer perspective, India has a huge potential. No surprise that most of the foreign brands, most of the brands are looking at India as a destination for their consumption or their consumer-oriented goods to be sold. And we firmly believe that as more and more, let's say, as the penetration of goods and services increases across even the rural areas, India's consumption story will unfold immensely. If you look at consumption story, it is not something which is only scheduled at a particular time. From morning till evening in our day-to-day lives, we touch upon many of the consumption stories, which probably are an essential part of our day-to-day life, right? We have your biscuit stories, you have consumer stories across electronics, you have some of the companies which telecommunication, without which this communication would not have been possible. You have healthcare services, you have supermarkets, you have paint companies, you have food and beverage companies. So consumer and of course then media and transportation. So there is media and entertainment. So there is so much happening around the consumer sector, and the sector in itself is quite wide. The ICICI Prudential Consumption ETF is going to be investing in the underlying constituents of the NIFTY India Consumption Index, which is an already launched index, and it is available for the methodology is available on the website for you to see. The top holdings are the well-known names like Hindustan Unilever, ITC, Bharti, Asian Paints, Maruti. And if you look at the sectoral compositions, consumer goods forms about 58%, while automotive forms about 17%, and consumer services is another 9%. So it's predominantly divided between consumer goods, auto, consumer services, telecom, healthcare services, etc. In terms of performance, if we see, it is not surprising that the consumer-oriented sector in the last 5 years has done well in India in terms of its performance. It has been able to beat the benchmark, traditional benchmark Nifty 50 returns over the last 5 years. And from an investor standpoint, what we believe is that if your overall asset allocation plan allows you to participate in a sensible manner across themes, this should be one of the themes which should be part of your portfolio right now. Like we always say that don't put all your eggs in one basket, diversify your portfolio. So like I said in the beginning, consumer is a segment which has good long-term growth potential. Because of the last 5 to 10 years of good performance, some of these companies have valuations which are on the expensive side, and hence as an investor, it may make perfect sense for you to start participating in an SIP mode on the exchange or in a bit-by-bit process. So accumulate the units over a period of time in the consumption story, because these are good quality companies in terms of their balance sheet management. And we believe that this will add value to your overall portfolio in the long run. Investment in equity should be done with the long run, and hence we basically believe that this is a good fit in your overall investment balance for the long term. What we believe is that apart from your equity investment, so like I said, your core investment from an investor perspective should be dynamic asset allocation schemes like the Balanced Advantage Fund category. On top of that, of course, you will have certain passive funds as well. Within the passive funds, the smart beta funds as well as the sector thematic funds may fit in, be it the FMCG ETF or the consumption ETF. And more importantly, apart from equities, we also believe that the state where the markets are, gold ETFs are something which an investor may look at, because with interest rates being low globally and a lot of money being pumped in, inflation goes up. And when generally inflation goes up, gold can prove to be an inflation hedge for investors. So gold as an asset class or gold ETF is something which we believe may be a part of your portfolio, 5 to 10% of your portfolio, especially since last 1 year, the gold returns have been flat to negative while equity has given a good return. So from a portfolio construct perspective, have dynamic asset allocation schemes like Balanced Advantage Fund, build a bouquet of passive funds in the ETF basket, be it FMCG ETF, be it consumption ETF or the other ETFs which are there, and also have gold as part of your portfolio, because we believe the gold ETF as part of your portfolio will help balance your portfolio out in terms of any volatility which may come into the equity markets. Also, if inflation goes up, generally gold as well, that can also be a good balancer for your portfolio. So gold ETFs are something which we believe should be part of your portfolio, and ICICI Prudential Gold ETF can be a good fit in your overall investment portfolio. With that, probably I'll stop. I'll be happy to take questions if any. Please put your questions in the chat box. Thank you. While we wait for other questions to come, there's one question which has come which says that what is the rationale for gold and why do we feel that gold can do well? The answer is pretty simple. If you look at gold as an investment destination, it generally does well when there is one, inflation, two, when a lot of liquidity is there in the world and the value of money comes down, and three, when there is a financial turmoil. So we do not know if there will be a financial turmoil, but what we know is there's a lot of money which has come in. If we look at the global market capitalization, it has crossed $100 trillion. The value of gold, total gold that is there in the world, is about $11 to $12 trillion as we speak. So the ratio of world market cap to gold has become very lopsided. It is at its 20-year low. So that is also one bull signal as far as gold is concerned. Second is just the under ownership. I think all of us probably have invested in equities or in other asset classes, but gold as an asset class has probably seen lesser investments in the last 1.5, 2 years, especially because it has underperformed. So that is also one good signal to invest, because there has been an underperformance and under ownership. And third and most important, in general, if we see the other asset classes have all done well. Real estate has done well globally, at least, and in India it's picking up. Equity markets have done so well. So if you're booking profits, right, there will be certain place where the money will be put. And in typical of humans, if there is a herd mentality which may come in terms of when there is a volatility in equity markets and gold prices start to shoot up, suddenly you will find that a lot more money is going into gold. And because the stock available of gold is limited, gold prices can shoot up significantly. And that's the rationale for gold ETFs. There's one more question, that what should we do? Should we invest in lump sum right now, or should we stagger our investments over a period of time in equities in general? Again, just to reiterate what I earlier mentioned, that whether it is lump sum or whether it is a systematic investment, what you should be aware of, what you should know is that you must have a very disciplined approach towards investing for the long term that will help you create wealth. You should know exactly how much money you want to put in equities. For long, we've seen investors invest in equity markets when it does well. Just look at the last 15 to 18 months. In March 2020, when the markets were at their lows, I think Nifty had gone down below 8,000. Very few investors had the courage to invest a large part of their money into equity markets. As the markets kept on bouncing back, the confidence kept on increasing. And today, when the markets are more than 18,000, the confidence is very high and investors are easily investing in equity markets. I think this greed and fear, these emotions are something which probably are a detractor in terms of allowing us to create wealth in the markets for the long run. If you keep that in check, I think that should be good. So the question for lump sum or SIP is something which you will be able to answer depending on what is your equity level, what is your equity investment approach. And if you have no equity at all, if you have low equity, then maybe you need to have some equity which you can stagger over the next few months. But if you have already got equity investments, then maybe a staggered approach towards equity in the themes which you like, or in the sectors which you like, or in the funds which you like would be beneficial. Like I said, have a good mix or a healthy mix of funds in your portfolio. The core should be always, in my opinion, in our opinion, it should be the Balance Advantage Fund category. And once you have the core as Balance Advantage Fund category, then you can increase your beta or your sector or thematic funds on top of it, or also the other funds which are available in the market. And gold, again, just to reiterate, we believe that gold ETF is something which should be 5 to 10% of your portfolio, especially at the current market juncture. Thank you. So just to summarize before we end, the ICICI Prudential Consumption ETF has opened on the 18th of October. It will close on 25th of October. Our approach towards the entire business is that you as an investor should have a one-stop solution or one-stop place where you get all the potential investment options that you need. And as part of that, we are basically curating one after another in terms of the themes and sectors which we believe will have a long-term horizon in India, or long-term, have a good long-term approach towards investing. And these sectors or themes should be a part of your portfolio at different points of time in different quantities. And that's where an advisor or a distributor advising you on your portfolio investments is extremely important. Thank you for listening in. And as always, it is our pleasure to interact with all of you on the ICICI Prudential Tarakki Talks. We wish you all a very happy Diwali and a festive season, and do take care of yourself. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.